and welcome to another edition of Honeycomb Digital Investments Chain of Events, where we look at market insights into the world of digital assets. My name is Baxter Hines. I'm the Chief Investment Officer here at Honeycomb Digital, and today is January 7th, 2022. I've gotten a lot of questions recently about why crypto prices have sold off so hard. What were the catalysts? What's going on? What should we expect to happen next? Well, in order to find out where we're going, we need to maybe explore for a moment where we've been. And what I tell people are the reasons why I think things have sold off in the last few days and weeks. I believe it really is driven by two factors. The first is I think there has been some selling due to tax loss harvesting or tax planning just in general. Being that we are in a time where we're beginning a new year and we've just ended a new year, rational investors will think about taxes. And we are also in a time where here in the United States, the government has been saying, hey, we may have to change tax policy. We've seen all kinds of stimulus that's been put into place because of COVID. We're trying to get through this pandemic. And so the government has just opened up the floodgates in terms of the spending that they have done to try and help us combat the economic repercussions of what COVID is bringing about. And people know that ain't free. There's going to have to be some way that that amount that's been spent gets paid for. And there are various ways that the government can combat it. Well, one way they can is let's raise taxes in the future. They can up the tax rates. And there has been a lot of talk that capital gains rates in particular will go up almost double what they are today. Let's just say the average person might pay 20% in capital gains plus the Obamacare tax on top of that. That puts you at around 23%. We're hearing rates now as high as 40 or more. And so if you're, again, a rational investor, you may be saying at the end of the last year, hey, I've got all these big gains in crypto. Let me take the gains now at the end of 2021. I know the gains will be taxed at the lower rate. I don't want to push into another year and take that bigger bite in terms of having to pay the IRS or some other government entity. And I'm sure there are investors throughout the world that are thinking the same thing. Well, that triggers all kinds of selling that are going to be specific to that particular period in time. Well, also, here we are in a new year. You may have some people who are saying, hey, I've got some losses from crypto. Maybe they didn't want to take them last year. They waited until after January 1st to do it. And so they're selling. This is not a new type of phenomenon. I saw it for many years when I was a manager in the equities markets. We had to think about a lot of the models that we were looking at for trying to value stock prices. And we would often say that the models were less effective because there was what was known as a January effect, meaning tax loss selling that was maybe happening in December would have an effect on January or January just in general because of people tax planning. You couldn't rely on models as much. So I think that's a very rational reason as to why we've seen some selling. But if I had to really pinpoint it and say what's causing the selling to be as furious as it's been over the last few months, really since about mid-November, I would say that one of the key culprits is that people have been deleveraging. Crypto is an asset class where people can add leverage very, very easily. And one of the reasons for that is because crypto makes for incredible collateral. Because of the digital nature of cryptocurrency, it's very cheap to trade in. It's very quick to trade in. You can program things like smart contracts to sell if certain aspects, like say the price in the market drops below a certain level, and it doesn't really cost you very much to hold collateral. So if I were to loan you money based on crypto that you held, you could give me that crypto. I could hold it again for a very small price. I would return it to you when you repaid the loan. But if certain conditions unfold in the market where the value of that crypto dropped because market prices went down, I would have reserved the right to sell it. It's very similar to what in the equity markets or even the bond markets is known as margin lending. And you get a margin call if prices drop. We see that in crypto prices as well. And so what happens is when prices go down, it triggers more selling because of these margin calls. And that begins to start to have a cascading effect until that leverage is washed out of the system or until a new wave of buyers comes around. And because of the volatility of crypto, a lot of times buyers will step back and just let the prices fall out, let people who are employing leverage into their portfolio, let them get washed out, come in and buy up at a later price. Just to kind of give another little bit of clarity of how that works, I'm not one to quote George Soros, the Hungarian billionaire, but I'm going to do that in this case because I think he illustrates it very well when he talked about in his book, The Alchemy of Finance. He discussed the Japanese real estate bubble that unfolded in the 1970s and 1980s. And the way he described it taking place was he said, look, there were people who would go out, they'd take out a loan. What would they do with the proceeds from the loan? They'd buy real estate. What would happen to the price of the real estate? Because people were buying with borrowed money, the price of the real estate would go up. Well, then what would happen to the value of the real estate that people held? It would go up, which meant the collateral value would go up. What would they do with that additional collateral? They'd go out and take out another loan. Then what would happen? The cycle would repeat itself. They would go out and buy more land with the borrowed money. Prices would go up, collateral values would go up. They go and just rinse and repeat over and over again. And it would just cycle the price of Japanese real estate up to just stratospheric type levels. Well, when the market sort of collapsed on its own weight, when there were no more buyers to do that, and people saw these just, again, astronomical prices for Japanese real estate, just to give a little bit of evidence around that, the Imperial Palace and the gardens around them in Tokyo at one point were worth more than the entire nation of Canada. So I've been to that site many times, and I don't know, it's maybe a square mile. Canada is millions of square miles. How in the world was the price of that? Yes, it's prime real estate in Tokyo, but it's not worth more than all of Canada. The prices were just completely irrational. Well, that led to a very long bear market in Japanese real estate prices. I use that example because it illustrates what can happen in the crypto space. Well, there are really two sources of leverage that can come about because of the digital nature of crypto. The first is there's certain trading platforms out there like BitMEX, for example. US investors can't trade there, but foreign investors certainly can. And they can allow you to trade up to 100 times leverage. So meaning if you put up, say, $1,000 worth of capital, they'll let you trade up to $100,000 worth of crypto. And small effects or small changes in the price of the crypto that you buy can either make for phenomenal returns or can wipe you out almost instantaneously. There are also innovative products that people like Arthur Hayes came up with where you have what's known as a perpetual swap. It's basically a futures contract that marks to market every certain number of hours, but it doesn't have any expiration. It goes on in perpetuity. It has an infinite lifespan to it. People can enter those for a very small amount of collateral, those futures markets, and just basically they're at the whim of the market. If the markets go in their favor, they can get rich very quickly. If it goes down against them, they're wiped out in no time flat. And what's really dangerous about those kinds of markets is that once you enter them, the computer programs or the trading platform will just sell your position or exit your position depending on which way you which way you're positioned, and it will cause again this cascading type of selling pressure in the marketplace. Again, very similar to what is known as a margin call. So that's been something that's I think affecting prices. But the second source of leverage is the amount of money that has been locked in DeFi. I think that the general crypto community and certainly the larger public has no idea about the incredible rise in the amount of funds that are locked in these smart contracts where you're using Ethereum or some other digital currency as your collateral. In, say, 2017, 2018, the money that was locked in DeFi was pretty much nothing. but you have seen this astronomical rise in terms of the amount of money that's being put into these smart contracts, to the point where today, again, we're in early January of 2022, there's still over $90 billion locked in DeFi. And that is just slightly down from the peak that occurred in mid-November, where you had about 110 billion locked up. If you look at the history of the chart of the money that's been locked in DeFi, the peaks of the market really coincide with the peaks in leverage. And it creates this sort of boom bust type of cycle where the expansion of credit and more people putting money into the DeFi system leads to higher prices. But when things start to turn, you have these vicious repayment of that credit cycles where it leads to, again, this bust in the market prices. And so I think that's really what you've been seeing over the last few weeks. If we take a look also just at what makes up the DeFi market, where this money's locked up, we can see that platforms like Maker and Curve, Convex, they have about, say, 20% market share each. But it's really spread, this money is spread out over multiple different platforms, multiple different types of categories of lending or derivatives. But long and short, this is leverage, and leverage can be dangerous and lead to even choppier types of markets. So I think as long as this leverage number is high, you still have some danger in the marketplace. People have been anticipating that a lot of institutional capital will come into the market. I think that will happen. But when you come out of a holiday season, things are slow to get moving at an institutional level or with a high net worth crowd. People have been on holiday. They're just getting back into the swing of things. I think that money will come. The people who were anticipating it and used leverage to try and make a profit off it, they're getting punished right now. I think this is a temporary type of sell-off event. I think that in another episode, we will discuss how interest rates and Fed tightening will impact crypto prices. But for now, to me, it's still a market that's being dominated by this deleveraging and tax selling. I think this will pass in time, but we'll keep you to date and soon have another episode of Chain of Events. I thank you for joining today and look forward to seeing you in the future.